Hello everyone, welcome back to our channel. If you're new to our channel, normally we talk about
Money.
in terms of personal finance, couple finance, family, budgeting, investment, side hustles, and anything about money.
So if you like this type of content, don't forget to subscribe, comment. That would be muchly appreciated.
Yeah.
In today's video, we're going to talk about home loan mistakes.
That are holding you back.
So I guess one of the stages when you are looking at buying a property, you're bound to need to borrow.
Home loan, because it's a lot of money in particular in Australia. In Sydney, median price in here are $1 million.
So these are the tips and tricks and the mistakes that we've gone through so far.
We've seen some of them we didn't go through.
Some of them that we've gone through. So I guess hopefully this will help you in any way as possible.
Yep.
So let's go through them.
Yep.
You want to go your one first?
Sure.
Sure.
So the first is not reviewing your home loan.
So for us, we review it
not every year, every 5 years in general.
For our loans, yeah?
Not ours. For us, it's for the rate for us. We still stuck with the same bank, but we can't change bank because our income.
So we
can't change.
For us
we don't
is
have
this.
The bargaining power.
Yeah, we don't have the bargaining power of changing to go to another bank or shop around to another bank. For us, it's like, hey, we just want to pay it off as quickly as possible. Our focus point is just pay it off as quickly as possible.
Yeah.
But at the same time, just with the same bank alone, not reviewing our home loan, it might cost us quite a lot. You know,
Correct.
When we first started, it was interest only.
Yes.
And then we changed it to principal and interest.
Yes.
And then now we change it again to fixed rate.
Yeah.
What is it? 3 years? 5 years?
2 years.
So
2 years is the lowest.
interest
We've
rate.
been fixed for a few years already, like almost 5 years.
Yeah. The reason why we fix it is because we're wanted to have the stability of the amount every single week.
It's more stable, easier for us to budget.
Yep.
That's the main purpose for us to budgeting, and then we just see compared to variable and fixed rate, it's not much difference, and mainly like when we start budgeting and we're paying principal down as well, so it is a lot cheaper.
So
I remember once I did a calculation. That time we were paying interest only variable rate, but if we change it to principal and interest fixed rate, it actually is cheaper.
that's it.
How does it make sense? I don't know. Do your number and review your home loan. And the other suggestion I'll get, let's say if you have a home loan, but you can foresee that your family or anything will change.
Yep. Or your income, your personal finance somehow
let's say you're going from full-time to self-employed, or you have new family member, like a newborn. Or, yes, anything. Your income may change. Maybe shop around before that.
And that's what we did. Our mortgage broker actually advised us, hey, if you're thinking of having a baby, you might want to do it now.
Yes, because your borrowing power will be a lot less with dependents. Depends on how many you have
and how old they are as well.
I don't know how old, because we're not there yet.
So the next one will be not getting the right features. So for us, for example, right now we made a mistake of we fixed the whole entire loan. And then realize, because circumstances change, and not getting the right features, it would cost you a little bit more on interest, possibly.
For our case, because we fix everything. If we trying to pay down the loan, which is what our strategy is, paying down more principal, we only can pay $5,000 a year without penalties. If we want to pay more than $5,000 on principal, we'll pay a fee.
Correct. Now that's because also our income now is actually changed as well. Throughout the years, your circumstances will change. Because beforehand we're looking at, you know what, that's probably the maximum we can get, like an extra $5,000 on our mortgage repayment. But now, since circumstances change, I'm like, hang on a second, I can pay more.
We can pay faster.
So our finances changes as well. Maybe you get a bonus, a big lump sum, or maybe you get a pay rise, or from a single income to dual income, or your side hustle will actually going through the roof. What do we do with this? Instead of us spending it to other things, we're looking at, well, why don't we put it down on the mortgage?
Yeah.
And then it looks out, based on our experience, well, we already capped at $5,000 based on our
Already.
features. So I'm like, oh, we already paid that extra. We don't want to pay the penalty. What do we have to do? Like, okay.
Spend money on somewhere else. We don't spend it, we invest.
We invested somewhere else, but if we had the choice, we would probably split our bonus
Investment,
or
our extra cash, maybe half to pay down the loan and half to investment.
That's any surplus income that we have.
Yeah.
So
in the future, we may look into split the loan,
Yep.
half of fixed, and the other half is variable, so we can pay it off faster without any penalty. Because before I heard people they have split the loan. Why do you have to do it? Make it so complicated? I don't.
yeah, and that was our thought process as well.
didn't
Like
know it.
that's why would you mind it so complicated? I'm like,
Yeah.
oh, okay, so
Now
you
it
know,
makes sense.
now it makes sense because like, oh, okay, our circumstances
I
do
can't
change.
pay off the whole loan in a short period of time. I'll fix that, right? But the other half, I should be able to do it maybe in 2 years' time.
Yeah, if not even the other way around. Like for us, let's say if you have $1,000 per week extra surplus, as an example, after your expenditure, then well, how about your fixed rate is for 2 years, which is what we have.
Yep.
The fixed rate is 2 years. Okay, then so it's $1,000 a week. So that means possibly I can fix it for 2 years, but $100,000 of that don't fix it.
Yeah.
So that would be
You
another
should
way.
be able to pay off that $100,000 in 2 years.
That's it.
Right.
So subject if your circumstances doesn't change, but I'm
Yeah.
sure your lifestyle will change in that 2
Yeah,
years.
but that's just some idea.
Yeah,
Come across with our
Yeah.
easy minds.
that's it.
Next one, getting stung with fees.
The amount of fees. Oh, at one stage we actually have to. We're looking at to break down the the interest only part because we had a big lump sum. We're willing to pay the fees. We got stung with the fees, but that fees is actually not better off versus carrying it on for 2 years.
Yeah.
So there's a lot of fees involved.
When you apply it, they charge you application fee.
Mm-hmm.
When you exit, they charge you paperwork fee again. When you do anything, they charge you some fee.
So
Anyway.
understand there's bound to be a lot of fees as you go.
Yeah, like our current bank, they have this property or mortgage package, and you have to pay a yearly fee.
A yearly fee.
I don't get it, but okay, I have to get it. And
So
we
can't
one
avoid
point
it.
I want to cancel it, but then if I cancel it, then our interest rate will go higher. And I did
Higher
a
than the
calculation.
fees.
Yes, so
Yeah.
based on the calculation, okay, I still better off paying that yearly fee. Okay, I'll stuck with you for some time, till. But I think they're reviewing and they're canceling that fee now.
Yeah.
I'm sure a lot of people complaining about the fee. It just doesn't make sense.
It doesn't make sense. It's
amount of
cheaper
fee.
for us to pay the fee versus let it the other way around.
Yeah.
So the next one will be falling for gimmicks. So one stage when we applied for our mortgage, we got given this, that, like all of these bells
Credit
and
card,
whistles.
right?
The main one would be the credit card. We were sitting down with a bank manager, and he just punched in a couple of numbers in the computer, and then automatically, you can get this. I guess the gimmicks would be a $50,000 credit card limit. And I'm like, no, no. Lower that down to 10,000, please. In case of emergency, which we don't really use.
Yeah.
I mean, but the thing, and we asked, can we close this? Can we not have it at all? No.
It's all attached.
It's attached to your mortgage, so you have to get it. Otherwise, it actually costs you more. So that's the gimmick that we
And
got.
we still have the card, but then we asked them to reduce the limit.
Very low amount.
And then one of my friends, he bought a house and he bought a new car. Oh, because the car, I can use my home loan, withdraw the home loan to buy a new car.
You package it all up.
It makes sense, huh?
Your car, your furniture, your TV, package it all up as
With a home loan.
With a home loan.
So the home, it costs you, let's say, $500,000. You pay deposit, let's say 10% for $50,000. But then So your loan for the home is $450,000, but then you buy the car, you buy furniture, you buy this and buy that. Yes, the home loan, because it's home loan interest, not the car interest, is cheaper.
Yeah.
But it's spread into 30 years, and then your mortgage loan amount become $550,000.
So that means
Doesn't make sense.
the repayment might look small, but you got to look at it. This is over 30 years, whereas a personal loan maybe up to 5 years.
Yeah.
Yes, the repayment is higher because there's the end period of 5
Only
years
5,
or
yep.
or less, or 7 years or whatever it is, but it's not over 30 years. So you have to take that into consideration as well.
Yeah.
The next one.
Wasting your money on products you don't need.
Ever gone to a shopping like we did this?
Yeah.
Like you go to the shopping center or something like that, ended up, whatever reason, you
Yeah.
kind of need this.
Yeah.
So home loans is the same thing. Like don't go, like just because they provide you with all of these product and services, it doesn't mean you have to take it all.
Correct.
Back to that car is an example.
Yeah.
So any other things that you can think of in that?
No.
No?
I don't know, just like pretty much we cover it.
So the next one will be paying high home loan rate. So for us, again, if you don't look at it in a maybe like once a year or once every 2 years.
You have to shop around. You really have to.
If you can go shop around and get a lower interest rate, sometimes actually makes sense to transfer from one
bank
to
a
another
lender.
bank.
Yeah.
From one lender to another lender. Then if it's cheaper, but at the same time you have to weigh off the costs, the admin costs involved.
Yeah, when you change over.
When you change it.
Sometimes the new lender will entice you. I will give you like $5,000 cash back.
Yeah.
Yeah, the 5,000 just can cover me from changing over from one to you.
Yeah. So maybe the other bank, let's say A bank, well, for you to transfer it to B bank, it's going to cost you $5,000.
Correct.
So effectively, you just make the bank win from one to another. For us, we don't want to do that. We just want to pay it off as quickly as possible. But in some circumstances, sometimes it's actually cheaper. If that's the case, then go ahead. But for us, like, no, I'm just going with one lender. I just want to get rid of it as quickly as possible, knocking it down as quickly as possible.
Yeah.
Anyway, that's just our 2 cents, guys. If you like this type of content, don't forget to subscribe, comment.
See you next time.
Bye.
Bye.